As a week draws to an end that has been focused, of course, on US tariffs and the potential for a government shutdown, the new week sees yet another whole raft of big data releases coming out. This time it is central banks that are going to be in focus, with the Federal Reserve coming up alongside the Bank of England and the BoJ. All in all, it looks like the volatility is here to stay. So let's get into exactly what we could see from an FX perspective and from an indices perspective around some of the big ticket items this week. So first and foremost, as we always do, we look at the big ticket items. Here are the top tier events according to Trading Economics. You might notice on the left, I have added one, and that is the SMB. For some reason, they didn't have it as a top tier event, but it certainly is. And it comes in a week where we see a huge focus on the central banks. Of course, the Federal Reserve are going to be the most important of the lot, because there's been a lot of talk and speculation over what the Fed might do in the face of what people appear to think is an impending recession. Of course, Donald Trump rowing back on Joe Biden's reliance on government spending, and instead saying, we're going to pull back on government spending, and in time, the private sector will be able to make up for that shortfall. Well, the private sector are also expected to suffer, because tariffs are not necessarily just being implemented and other countries roll over. You're seeing the likes of Canada coming back and hiking prices on electricity. You're seeing the European Union then hiking up the price of whiskey. So we're seeing this sort of tit for tat trade war. Certainly, if we look back to his first sort of stint in the White House, you would say that by and large, this initial bit of sort of uncertainty should likely shake out, and ultimately we find agreements for many of these countries. But there's a feeling that this time he doesn't actually care about the markets, and that is an interesting point to note. Certainly there's been this idea of a Trump put, where essentially if the market drops by a certain amount, he'll row back on these ideals and instead just think, well, I've got to do what's right for the market. Instead, he's saying he doesn't really care about the market. He's not watching that, and that he's no way going to row back on his current measures that at the moment has been focused on the likes of Canada, Mexico, China, to an extent the EU, but then we've got the reciprocal tariffs coming into play at the beginning of April. And so, that theme is likely to continue. Now, how is it relevant for the Federal Reserve? Well, it impacts a number of different things. It impacts expectations for growth and economic activity. It impacts jobs, because, of course, the cutbacks that you see in the government sector are likely to drive down some of the payrolls numbers and the like. And then it impacts inflation. Of course, when you're hiking up tariffs, that's essentially a tax on goods coming into the country, and therefore it's more expensive. It's not a guarantee that everyone's going to be able to just switch away from foreign goods and instead just buy a US produce. And also, producers in the US a lot of the time will import parts of production to then be able to make their own goods. So you might even see internal inflation coming into play from that perspective. All of that adds up to a perception that the Fed would like to be able to do more, but perhaps they won't be able to because of inflation. Now, we did recently see the US CPI numbers, and they both headline and core came in below expectations. That is a positive thing. But many within the markets looked beyond that and said, well, by and large, we haven't really seen the tariffs yet. So it's to be expected that we don't necessarily see its full implications coming into play quite yet. Nonetheless, closing the week with a little bit more of a positive outlook in terms of markets, headed up by the Hang Seng overnight, with strong gains after the PBOC promised to provide more support. European markets doing well, and US markets lifting up a little bit. And with the week ahead pointing towards a Federal Reserve coming into play, it's their opportunity to state their claim and show exactly what their outlook is. Will they step in if need be, if the economy goes south, or are they going to remain very hesitant? So far, the tones coming out of the Federal Reserve have pointed in exactly that direction. Essentially, you're looking at a Federal Reserve that are saying, look, we don't know the direction of travel for this. Ultimately, if they take a huge amount of action in terms of rates right now, and then suddenly Donald Trump finds agreements with all these nations, then expectations for where growth might go don't necessarily count as the reality of it. So there's likely to be a data-dependent approach going forward. That's for sure. So I've rabbited on. It's 5 minutes and we haven't actually got into exactly what all the big ticket items are. So essentially, you've got rate decisions from a number of the different central banks here. And then we've got the jobs report on Friday. So like I said, that was a sort of summary of what's going on in the US at the moment. And so when we're looking at the FOMC meeting, you're talking about Wednesday, and the rest of it, you know, they're interesting, but by and large, they're all going to be trumped, excuse the pun, by what's happening on Wednesday. Markets expect to see rates remain steady. The economic projections are also going to be a bit mixed. I mean, ultimately, a lot of it comes down to unknowns, right? We don't know how this is all going to shake out. And so, you know, markets are by and large expecting little from the Fed, but certainly they'll be watching the commentary that goes around it. So a few different things to look at. First and foremost, here's the inflation outlook as things stand. You can see a move lower in terms of headline CPI. That comes off the back of months and months of higher and higher monthly CPI numbers coming out, which peaked out in January. And then we saw a nice pullback, thankfully, on that monthly metric. And that helped drive that headline CPI number down to 2.8. But still, if we look at the annualized figures, I've not annualized them both at exactly the same rate here. So you can see the CPI is the headline number. Then the core number I've got as the PCE, because those are the ones I think the Fed are more likely to follow. Now, the numbers you've got at the bottom here are 2.6 and 2.4. That essentially means what's the best it's going to potentially get to before we see inflation possibly stagnate or start to move higher. And that's essentially once those April metrics drop out. And then you've got that very low May figure. So we're only a couple of months away from this, but bearing in mind we've seen CPI, we haven't seen the core PCE, and that's why I think I did a 10-month annualized on the CPI, but a 9-month annualized on the core PCE. They come out at 2.6 and 2.4. So there is a good chance that, you know, in a couple of months' time we'll be mid-twos, and you could say that, well, you know, that's not necessarily too problematic. And certainly if the economy is souring, then that could point towards action from the Federal Reserve. Now, this is the relationship between the Citigroup Economic Surprise Index, which essentially takes all the different data that comes out for the US and points towards whether it's outperforming or underperforming, and then the US 10-year yield. And what we have seen recently, although we've seen a bit of a bump over a short term in the 10-year, but essentially the direction of travel at the moment is downwards in terms of the US 10-year for a number of different reasons. There is currently a speculation that Donald Trump is essentially looking to drive down the borrowing costs because they've got a huge amount of government treasuries that need rolling over this year, and they need to do that at a lower cost. So the weakness of US yields is by design. It can come via different methods. Part of it could be lower expectations in terms of economic growth in the US. And certainly we've got that at the moment. We've got fears around the US, the direction of travel for the US economy. It can also come via heightened expectations for rate cuts from the central banks. And certainly that's something we've seen from the Federal Reserve. We haven't seen it from them, but we've seen it around it. Certainly markets now pricing in a greater degree of easing this year than we were not so long ago. So you can see a month ago, the most likely event markets priced in, according to the CME, was a single rate cut. And now where are we? Well, the most likely event is 3 rate cuts. So that's a significant shift, and that's been a major driver of downside for yields because you're seeing a shift in expectations and markets adjust accordingly. And that's part of why we're seeing this weakness playing out for the US dollar, certainly. And alongside that, we're seeing weakness in terms of US equities relative to other equities, you know, the likes of Europe, the likes of China doing very well. Not necessarily the case when it comes to US markets. And certainly what we've seen is that the likes of the S&P 500 now moved into contraction territory, dropped down into 10% decline. So let's just firstly jump onto this chart so we can see from let's go full screen. So I wanted to show you the S&P 500. Quite frankly, I think it's probably better to be trading the likes of the US dollar for this FOMC meeting, but I'll cover the US dollar in one of the other segments. And so it probably makes sense to look at US markets just because everyone at the moment is so fearful, wondering exactly what's going to be coming next. And obviously, you know, I don't have a crystal ball. I can't tell you exactly whether this is going to be the end of the sell-off per se. But certainly we can look into it and see exactly how it's shaping up. So long-term trend, as we all know, long-term is Let's just get rid of that. Long term, let's put on a log chart so you can see it a bit more clearly. Very clearly, a great market to be in. Now, a lot of the time when you see sell-offs, they can be relatively fleeting in nature. When is that not the case? Well, generally when you see a sort of major drawn out crisis, we're talking about the pandemic and the like. But even then, you're talking about a pullback of like a couple of months, and then suddenly the bulls are back into play. We're obviously only in the first month of this. And so there is a possibility that if we see a sort of protracted contraction in the US, suddenly you start to see earnings being revised downwards because of the expectation of higher costs or potentially lower sort of demand, the possibility of tariffs hindering global sales. And so all of a sudden you see lower earnings. And then you have the fact that people have been pricing the likes of the S&P 500 very highly. So the price to earnings ratio was 27. It's now 25. You might say, okay, well, we're getting back into areas, the more it declines, the cheaper it is. That could be the case if earnings stay the same. But, in a worst case scenario, you sort of see declines. And then instead of seeing a better price to earnings ratio, the earnings simply decline alongside it. And therefore, you've got a market that's declining, but still remains expensive relative to historical norms. So you can see here, we're pulling back. And so we're trying to ascertain exactly what we're retracing here. So are we going to come into a sort of long-term trend line kind of area? Have we got a trend line here? So we've got that down there. So we've got that level. If we look on the weekly time frame, you can see that if we're looking in terms of what we're potentially retracing, this is the most obvious thing here, right? So we've got this long lower shadow here on this candle, and then that's very clearly a swing low here. So now that we've placed a double top formation on a weekly time frame, we can point towards that as being a potential target if we're looking downwards. So 375, if projected downwards, is around this area, right? So it's between the 76.4 and the 61.8. That by and large tallies up with where this ascending trend line is. It points towards, of course, a little bit more sort of maybe consolidation or a gradual move towards the downside. But it does point towards a possibility of further downside, possibly towards trendline support or the 76.4. At the moment, you can see that we're by and large sort of near enough tagging that 61.8 and starting to move upwards. But if we look at the sort of intraday chart, you can see that the trend very clearly still remains bearish. So I would be buying right now. And each time it pops, or I say pops, each time it moves higher, it doesn't seem to last very long. So at the moment, we've rallied into the sort of 61.8 fib. I still think there's a strong possibility of further downside. And if I was to look at an area that looks interesting, like I said, it would be around about that sort of 53.70s kind of area where you start to get that 76.4, the ascending trend line, and those kind of areas coming into play, and that double top projection towards the downside. So yeah, that's my outlook at the moment. And certainly if the Federal Reserve are to say, well, we're not going to do anything, we're going to sit on our hands, and that comes alongside a weakening of the US economy and a potential rise in terms of inflation, because of course tariffs haven't kicked in, then that's a worst case scenario, right? You're talking about stagflation with a Federal Reserve that don't do anything, and therefore the economy is just left to its own devices, and Donald Trump continues to come out in a very strong fashion. Doesn't necessarily make you feel confident that this is on the cusp of ending, that's for sure. So that's the US. Elsewhere, we've got Japan coming into play. So Japan's rate decision is overnight. So it's coming into Wednesday. This is sort of UK time on here. So Tuesday night coming into Wednesday morning. Markets expect to see rates on hold here. And by and large, there's little chance that we do see a hike this time around. But of course, what's notable about this is whilst markets are pricing in a greater degree of easing for the Federal Reserve, and many of the central banks are easing in a pretty dramatic fashion, that's not necessarily the case in Japan. Of course, we've seen inflation moving towards the upside, and so it sort of pushes them to tighten rates further. That being said, it is notable that we've started to see a little bit of a shift in terms of that narrative around the resurgence in inflation. We saw the Tokyo inflation moving towards the downside. That typically can provide a precursor to the headline sort of nationwide number moving lower as well. And if you look at the bottom here, we've got the possibility of core inflation dropping down from 3.2 to 2.8, whereas headline up to 4.2 from 4. So a little bit of something for everyone there, really. But the monthly figure of 0.2 is certainly more palatable than 0.5 that we saw last time around. In terms of the breakdown here, you can see that Tokyo reading down to 2.9, the headline number is at 4. Market's currently pricing in a move up to 4.2, but like we can see, they generally move together. So I wouldn't be surprised to see Japanese inflation actually move lower on a headline number if it follows that nationwide figure. You can see the month-on-month nationwide numbers in the middle, 0.6, 0.5, 0.6, 0.4. So we're seeing very strong numbers of late, and that is reflected in the annualized figures at the bottom there, which do point towards the Japanese inflation picture really picking up steam of late, which points towards the BoJ potentially needing to tighten rates further. So if we see weak inflation coming out, then, you know, by and large, it starts to sort of cool the idea of plenty of hikes from the BoJ and potentially sort of take some of the heat out of the Japanese yen. But what's been notable at the moment is, of course, you're seeing people wanting to get into haven assets. But with the weakness in terms of the US yields, that means that the US dollar is actually getting hit. So you're seeing the dollar declining alongside equity markets. That's not necessarily the norm because we usually see the dollar playing the role of the haven. But this time around it is. And so people look for havens elsewhere. And the Japanese yen has been one of them, particularly because they're, of course, in a position where they're likely to tighten further. Now, that relative relationship between yields and the currency are highlighted here with the US 10-year yield divided by the Japanese 10-year yield declining alongside the likes of dollar yen. So you'll find this a lot of the time with many of these FX pairs, that the relationships between yields will essentially reflect where the currencies are going to go. That's exactly what's happening here. If you expect to see, or if the BoJ come out and point in the direction of tightening in the near term, then, you know, it could lift the yen once again and drive dollar yen lower. So this is the expectations for it. Essentially no change expected. Hike only 7% chance. Markets are pointed towards. The next time we're expecting a rate hike is actually July. So by and large, I think there's quite a lot of sort of leeway for them to bring that date forward if they so wish. It's not like markets are overwhelmingly expecting a hike. There's certainly a good couple of months ahead that they sort of May and June that they could opt to raise rates. And if they do so, then that would be sort of against market expectations and point towards strength for the likes of the 10-year yield and the likes and downside in terms of dollar yen. So let's look at that chart. So dollar yen, here we go. So here's dollar yen from the weekly time frame. It looks like this. Let's just go full screen. So the weekly time frame looks like this. So like we said, we're pointing towards weakness of late around the sort of election period and the repercussions that have been there for the sort of US dollar as a whole. It's this dollar index. If we overlay it, we'll try. There you go. So as you can see, very close relationship. We're seeing a bit of a pop at the moment. There is a good chance that that fades once again. If you're looking at the current trend is bearish. If you look at, say, the 4-hour chart. So the latest swing high that you're going to be looking at here is up here. And until that gets broken, then you're looking at near-term upside as being a potential retracement of the sell-off from, there we go. Here we go. So of the sell-off from 151.3. So you look out for resistance here. The fib levels 149s, 150s, that kind of area for the bears to potentially come back into play. But certainly if we had a report that an FOMC meeting that points towards them tightening in the nearer months, that could drive this pair lower. Same kind of thing in terms of inflation. If we see stronger than expected inflation, then it drives it lower. But bear in mind, of course, if we do see the inflation data coming out the back end of the week and it follows the Tokyo numbers where we see weaker than expected inflation, maybe it does the opposite. Maybe it sees a continuation of the recent little bout of strength for dollar yen. But certainly as things stand, we've got a clear trend that's been playing out over the course of the last month of weakness for dollar yen. Until we break out of that intraday trend of lower highs, lower lows, then it points towards further downside to come for this pair. And finally, let's jump into the UK. UK has just seen GDP, industrial production and manufacturing production all moving into negative territory. Their GDP figure was minus 0.1. Notable that the prior month we saw a 0.4 reading. So, you average it out, it's not too bad. But certainly it's not necessarily great news. And it comes just before the Bank of England opt to cut rates or not. On Thursday. That comes alongside the jobs report, where we've got a expectation of unemployment flat at 4.4. The average hourly earnings expected to decline a little bit to 5.9. And then the likes of the employment change figure to sort of drop back to 60K from 107K. In terms of the sort of outlook for inflation in the UK at the moment, it has been moving higher, but last time around we've got this negative reading, but it's January when you often see sort of negative figures. You can see it from the left-hand side of the screen. We saw a similar kind of thing, but we're now moving into this phase, a 3-month phase, where we're likely to see greater disinflation kicking in. And so, that sort of makes things seem a little bit better. And certainly if you look at the 8-month annualized, it does point towards UK inflation within, say, 3 to 4 months as getting down below that 2% target. So are we going to see the Bank of England opt to cut rates? Essentially, you're looking here at a possibility, but an outside chance. And instead, markets pricing in a rate cut for May to come to fruition. Beyond that, you're looking at another rate cut, maybe in August or September. So by and large, you're talking about 2 rate cuts for the rest of the year here for the Bank of England, according to market expectations. Now, it's notable that if you look at the Bank of England, it's this sort of thick green line at the top. It's the highest of all of them within this chart. And with the possibility of just 2 rate cuts for the rest of this year, there's a possibility that the pound holds up relatively well, depending on exactly the outlook from the BoE. You add to that the sort of trade discussions that have been underway and the fact that the UK has a deficit with the US. That points towards the UK not necessarily getting hit to the same degree as some of the other countries. Now, key to that is Canada. Canada is right in the firing line right now with the US. And, that does provide the basis for the economy to weaken under the weight of tariffs. And that means the Bank of Canada may be having to cut at, I wouldn't say a faster rate, but continue to cut. I wouldn't necessarily say a faster rate, because if you look at the pace of easing for the BOC, it's the purple line. No, that's the RBA. Yeah, it is the purple line. It's a sort of thinner purple line. So we've seen a very sharp decline in terms of rates for the BOC. And certainly that points towards the potential, alongside fears around the direction of travel for the Canadian economy, points towards the potential for weakness for the Canadian dollar. One that we've been looking at for a bit now is the pound against the Canadian dollar. So let's just quickly jump into that. So from a wider perspective, the weekly time frame, what we can see is that we've come into levels not seen since 2016. So that means we don't really have any resistance up here, right? So we've come out of this consolidation phase, we've blasted higher, and now we're seeing a bit of consolidation once again. We don't necessarily know exactly what we're doing. Have we got a bit carried away with ourselves? Quite possibly. When you see a move of that size, sometimes you need to see a pause, you need to see a pullback. And so, let's just try and line up these lines. So you've got a possibility of trendline support to come into play here. You've got a possibility that we sort of retrace into some of this move here. But certainly, I think that we're in a position where the Canadian dollar has been hit hard. Now we need to see whether we see the breakdown in relationships between them and the US continue to deteriorate. Do they look like suddenly it's softening, which we've actually seen a little bit today? And then with the UK, is the UK going to be hit by tariffs? Looks like it might do a little bit with the steel side of things. But I very much doubt that Keir Starmer is going to sort of fight back on that front. He's been trying his best to position himself as an intermediary and a friend of Donald Trump. That should be good for the pound. And again, if we're looking at the outlook for the Bank of England meeting, if we do see them hold off this time and take a relatively cautious approach here, once again, that could benefit the pound against the Canadian dollar. So look out for this pair. I think it's a particularly interesting one. Of course, we've seen this really nice run up so far. We're pulling back, sort of consolidating a bit at the moment, but whether we see a retracement and a rally or if we see a rally off of trendline support here, I think there's a good chance we do see the bulls coming back into play soon enough. The question mark here is, have we run too far? And if that is the case, then to what degree would this retracement come into play? But certainly, given the fact that we've rallied up through all these resistance levels, it's a good chance that we do see further upside coming into play for the pound against the Canadian dollar before long. I hope that's been useful for you guys. Another really busy week ahead. Like I said, we've also got the Swiss National Bank to be looking out for. So 4 major central bank decisions coming within a week that, quite frankly, Donald Trump will probably do his best to trump all of those events anyway. So it's going to be yet more volatility, uncertainty, and interesting price action for traders out there. But certainly it's an equally interesting but difficult time to trade, because a lot of the time you might see sort of announcements coming from left field that you hadn't necessarily planned for. Not everything you hear from Donald Trump comes out on an economic calendar. But right now, we have got some pretty key themes. That has been equity market weakness, strength in terms of the likes of gold, weakness in terms of the US 10-year, that driving weakness for the US dollar. And so, yeah, people continue to try and find the bottom for some of these markets. You know, are we going to continue to rally in terms of gold? You know, there's plenty to sink your teeth into right now as a trader. That's it for today. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day, great weekend, and great week ahead. Thank you.